Welcome. FX International Consultants, it's a company that helps you accomplish your goals, either in the stock market or Forex market. We can help you accomplish your goals. Mentoring is our specialties, okay? FX International Consultants, it's here for you. Today we're going to talk about one specific tool that will be able to help you accomplish your goals. This one is very reliable and it works most of the time. 90% of the time works. So you can be confident when you use this tool. You can come and visit us at www.onedailytrade.com. Okay, so let's talk about this tool. In order to be successful in the Forex market, investors and traders usually use two different approaches. Okay, either the technical approach or the fundamental approach. Although both have their logic, it is important to recognize that when we use both in the proper manner, we can be very successful. Okay. Today we're going to talk about the second one. In this case, we're going to focus on the fundamental analysis. One of the tools we use in our company is the economic tool. To be more specific, we can use a familiar diagram from Principles of Economics. Okay, the supply and demand diagram. Okay, the diagram will help us to determine if a currency is going to appreciate or depreciate in relation to the other one. In this case, we're going to figure that out. Let's talk about one specific economic. In this case, we're going to talk about New Zealand. But before we move into that, let's talk about the supply and demand and how this principle works. Okay, when the supply, as we can see this line, the black line, increases, or the quantity increases, from this point to this point, as we can see on the horizontal line we have the quantity, and on the vertical line we have the price. We have the demand line and the supply. When the supply increases, we can see here, what happens to the price? Usually decreases, okay? So when there is more supply, the prices of one particular currency tends to depreciate or devalue, right? This is usually nowadays we see the Federal Reserve doing or pumping money, in this case increasing the supply of US dollars, and we can see that the prices tend to move down. And also we can see that in Japan or in the Eurozone nowadays. So it's very popular, and when we have this knowledge, we can make money out of this principle, and it is very reliable tool that we use all the time. Okay, so again, when the supply increases, the prices tend to decrease. The price in this case of the currency tend to decrease. Now let's talk about when the demand increases. When the demand increases, as we can see in here, from this point and increases to this point right there, the demand increases, or the quantity for one specific currency increases. What happens to the prices? These prices tend to increase as well. All right, so very important, and we'll use this in one specific economy, in this case New Zealand. Let's talk about New Zealand, and before we even see this graph, let's talk what happened in New Zealand and how this economy tends to work. Okay, New Zealand is a net exporter country. When we talk about a net exporter country, we talk about that they tend to export more than they import. Okay, what they export? They export principally commodities. Okay, when we talk about commodities, usually they export dairy products, cheese, for example, meat, and obviously some minerals, and also some metals, and specifically gold. Okay, their principal partners are Australia and China. All right, so let's go back to the principle, and then we can apply that in this specific economy. Before the recession, the supply, or actually the demand for the products from New Zealand were increasing, and when we saw that the increase on the demand, what happens to the prices tend to increase as well. But during 2008, 2010, we went into a global recession. What we're talking about when we talk about global recession is we're talking about that the demand for certain products, in this case from the New Zealand point of view, decrease. What happened when the demand for the products decrease? Usually the currency tends to depreciate in value. As we can see in here, from this period of time, 2008 all the way to 2010, we can see an increase from 0.8 all the way to 0.5. Okay, if we talk about that in real money, we're talking about between $400, $40, $4,000, $40,000, $400,000. Depends on your account, how much money you have in your account, how much leverage you're using, but that can be very profitable if you use it correctly. Okay, and that's what we're here for. We can help you with that. All right, let's go on the next slide. When we talk about gross domestic product, it goes in the same pattern. What happens when the demand decreases? Usually the gross domestic product tends to decrease as well. And we can see exactly that between 2008 and 2010. All right. So when we know those principles, when we understand the principle, we can make money. All right. Again, in the same token, we talk about the fiscal deficit between 2008 2010. It decreased a lot higher than what it is right now. But anyways, so when we understand these principles, we can make money out of the currency. Now, this is one of the platforms that we use, IBFX platforms, one of the brokers. Now, if we translate what we knew or the news and translate into money, we're talking about a lot of money. In this case, from that specific pink line on the top, which is close to 0.8300, and the bottom one all the way to 0.4800. So we translate this again into money. We're talking about $40, $400, $4,000, $40,000. Knowing this principle, we can make money, all right? And we're here for you to help you if you don't understand. Another important indicator in the same token is natural disasters. When natural disasters happen or occur in one specific country, what happens is the currency tends to devalue again. And this is exactly what happened at the beginning of 2011. An earthquake happened in New Zealand. All right. In this case, we're talking about the supply. All right. When the supply for one specific product, in this case, they were not able to produce enough, so the currency tends to devalue. And this is what we're looking at right now, exactly during a period of time. Now, when an earthquake happens, if it's not really big, what happens usually is there for 2 months. Okay, so we can see the currency devaluing for 2 months, actually, as we can see in here. All right, so when something like that happens, if we are either investors or traders, we can tend to think that usually the currency will depreciate or devalue. All right, as we can see in here, this is another good example. And one more example that I want to cover today is obviously one of the biggest ones, economic indicator in this case, talking about the unemployment rate. These figures are from April 2013, actually. Okay, what happened with the New Zealand? The unemployment rate increased from 6.7% all the way to 7.3%. What happened with that news? Well, as we can expect, the currency tends to depreciate in value because the investors are not very confident about the numbers. When unemployment rate increases in any country, what happens to the investors? They will see as a risky currency or as a risky country to invest in. And that's exactly what happens. So they tend to move the money out of that specific country. And when they move money out of that country, the currency usually tends to devalue, as we can see in this example. All right. So if you have any questions, please feel free to contact us, www.onedailytrade.com, or by phone if you are in the United States, Canada, Puerto Rico, 801-413-4291, 801-979-4811. Okay, we're here for you. A pleasure. Have a nice day. Bye.